Hello everyone, welcome to Sam's Summaries. This episode is a deep dive discussion into Sam Fury's summary of Chapter 6 from the book How to Make Money in Stocks by William O'Neill. It has been created with the help of AI. The chapter is titled Supply and Demand, Big Volume Demand at Key Points. You can read the original post at samfury.com.
All right, so we're diving deep into stock market mechanics today.
Yeah.
With a big focus on supply and demand, like the real nitty-gritty.
The foundation of it all.
Yeah.
There.
Yeah, so we're going to kind of like unpack that, see what O'Neill's saying, and see how our listeners can,
Put it into practice.
put it into practice exactly to their advantage.
Yeah, it's amazing how a concept as simple as supply and demand, something we see every day.
Right, like in the grocery store.
Yeah, exactly. Or trying to get concert tickets plays such a huge role in the stock market.
I know, I was thinking about that. It's like a time I tried to see
Oh, yeah.
my favorite band, and the tickets were going for crazy money on the resale market.
Just because there were like two left?
Exactly. Limited supply, high demand, prices go through the roof.
That's the game.
It's the same with stocks, isn't it?
Absolutely. And one of the first things to consider is the number of shares a company has outstanding. Think of it like a company with 1 billion shares outstanding. It's like a massive cruise ship. It takes a lot to turn it around.
Oh, I see, yeah.
But a smaller company, with fewer shares.
A little speedboat.
Yeah, like a speedboat, much more agile, responsive.
Or nimble.
Exactly.
So smaller companies, smaller cap stocks, we're talking about potentially bigger price swings, yeah.
Absolutely. Higher risk, higher potential reward. That's a trade-off.
Classic.
And with fewer shares available, less liquidity.
Right.
It can be a bit more volatile.
But volatility can be a good thing sometimes.
Oh, yeah. Yeah, if you know what you're doing.
That's like surfing, gotta ride that wave.
Right. But then you've also got to consider the floating supply.
Yeah. Yeah, that's the shares that are actually available for trading.
That's right. The ones actually in play.
But it's not just the total number, right?
No, not at all. It's like musical chairs, the number of seats determines how competitive it gets. You got the total number of shares issued, but then some are held by insiders, institutions, long-term investors.
Right, they're not going anywhere.
They're sitting pretty. It's the remaining shares, the float, that drives the day-to-day action.
Interesting. So if a company's founders still hold a bunch of stock,
Yeah.
that shrinks the float.
It does, but you know what? That can actually be a good sign.
Right. Shows they believe in the company.
Confidence in their own future prospects.
Yeah, exactly. And when companies buy back their own stock,
Yeah.
that's a positive signal too, right?
Absolutely, especially if earnings are growing, it suggests they think their stock is undervalued.
Yeah, like, hey, we think this is a good deal. We're going to buy some.
They're putting their money where their mouth is.
Putting their money where their mouth is, exactly.
And then you've got stock splits. Those are always interesting.
Yeah, stock splits always kind of confuse me, to be honest.
I understand the price per share goes down, but your investment value stays the same, so what's the deal?
What's the point?
Well, it's more about psychology and accessibility.
Okay.
It's like, imagine you have a $100 bill, right?
Yeah.
You exchange it for $10 bills. Still got $100, just divided differently.
Right.
Stock splits kind of like that, makes it more affordable to more investors, maybe attracts new buyers.
Wider range.
Yeah, wider range. But O'Neill warns about multiple stock splits.
Why is that?
It can be a red flag. Like, they're more focused on short-term hype than real value.
Oh, I see.
It's like slicing a cake thinner and thinner. Eventually, you just got crumbs.
You just got crumbs, yeah.
Not much substance there.
Not much substance. All right, so we talked about supply, but what about the company's financial health?
Oh, yeah, that's huge.
Like, how much debt is too much? That's always a tricky one for me.
It's a great question. And O'Neill's very clear: excessive debt, big warning sign.
Red
High debt to equity ratio, it's like having a huge mortgage.
weighing them down.
Absolutely. Just like with our personal finances.
Yeah, got to live within your means, right?
Exactly. And ideally, a company should be paying down its debt over time.
Like a responsible homeowner.
Making those extra mortgage payments. Exactly.
Yeah.
And watch out for those convertible bonds. They can dilute earnings per share down the line.
Yeah. Got to look beyond the surface.
Long-term implications.
See the bigger picture.
Exactly.
Yeah. Now, I think this is the most interesting part. The daily trading volume.
Oh, yeah. That's the pulse.
O'Neill calls it the best way to gauge what's really going on.
It's the heartbeat, tells you if there's real energy behind a price move.
Oh, I like that analogy.
High volume during a rally, that's a chorus of cheers, strong demand, conviction.
Like a packed concert.
Exactly. Everyone rushing to get in.
But if volume's low during a pullback,
Could just be a lack of selling pressure.
People are holding on.
They're riding it out.
They're in it for the long haul.
And then O'Neill talks about that 40% above normal volume for breakouts.
Yeah, what's the deal with that number?
It's a confirmation signal. That surge of volume shows there's real buying pressure,
It's a sign.
overcoming resistance, pushing the price higher.
Powerful stuff.
It is.
So what's the main thing you want our listener to take away from all this?
Remember, stock prices aren't random. There's a story, and it's driven by supply and demand.
Forces at play.
So many factors influencing it.
Understand those forces, you get an edge.
See the bigger picture?
And a final thought for our listeners.
Oh, yeah.
If stock splits don't change a company's value, why do prices often go up after a split?
That's a great question.
What does that say about market psychology?
Something to ponder.
Happy investing, everybody.
Thanks for tuning in to Sam's Summaries. If you found this episode useful, let us know with a like, follow, and share. Also, if you haven't already, be sure to visit samfury.com to get free access to all of Sam's original summaries. You can also get any of Sam's books and other exclusive content. It's all completely free at samfury.com.